So tonight we're going to be hearing from Marna Pratt, and her business is Books Co. Bookkeeping, and she is based in Red Deer, Alberta. And I've known Marna for just about 2 years. We were friends first, and then she started doing my books about, I don't know, a year ago, a year and a half ago. So it's been great. She's been very enlightening about some of the things I can do, more so the things I can't do as opposed to the things I can't. So it's been fantastic, and I'm just going to turn it over to her. I'm going to ask you all to go ahead and mute yourselves. I think everybody is already muted, and Marna can be unmuted. And then we're just going to go ahead and listen to what Marna has to say. Again, ask the questions if they come up, and we'll have room for questions at the end. So Marna, take it away, please.
All right. So let me try and make sure that I'm getting on the go here. Okay, perfect. So I am going to tell you guys a little bit about myself. I have owned my own bookkeeping company since 2011. Before that, I was in sales and did a lot of different sales. And many years ago, I was a bookkeeper. So this is kind of like my second career, or third career, but it's my first career. So I work with a wide range of different companies, and you can find my contact information here. I'll also put it on at the end. So I'm going to talk about bookkeeping and Canada Revenue Agency, really how to audit-proof your business, because everybody's in here to make money, and audit-proofing your business is what you want to do. So our tax system is based on a self-assessment, which means that taxpayers have to voluntarily comply with the requirements to file a tax return, correctly assessing what taxes they owe and pay them on time. So that means that it's up to you. Canada Revenue is not going to come and calculate what you owe. If they do come back at you and calculate what you owe, it's usually a lot more money than what you really do owe if you had calculated it yourself. So one of the things about operating a business is Canada Revenue is very firm in this and saying you must have an expectation of profit. If there's no expectation of profit, it's a hobby. So you have to show an expectation of profit. And it doesn't need to be in the first year or second year. You just have to show that you are expecting a profit as your business grows.
Marna, can I interrupt you there?
Yeah.
So, would this look like signing somebody up in your organization from time to time?
The person signing up may get into it for other reasons. So if they're not in it to grow a business, they are in it as a hobby.
Right, but I'm thinking like if you're making, you know, $100 to $200 and the government wants to see an expectation of profit. So for me, for an example, they want to see an expectation of profit for me. That basically looks like me actually signing somebody up from time to time, right? Because I'm expecting to do this. That's what that means. Okay.
Yes, that's exactly what that means.
Perfect.
You are in it to make money. So you're not in it just to use the oils. You are in it to make money.
Okay, so It doesn't matter how fast you're growing, just as long as there's something there that indicates you are.
Exactly. Exactly. And hey, sometimes you might not necessarily grow, you might decrease, but as long as you are in it to make money eventually, that's all that Canada Revenue cares about. So just a word of warning, small business owners also face a higher risk of audit than other taxpayers because it is self-assessed. You can write off a lot more things. You are open to tax audits a lot more than other businesses. Whether that happens or not is not necessarily true, but you are open to tax audits a lot more. So there's a couple different types of businesses, and I'm going to touch on this because Some of the deductions are a little bit different for an incorporation as opposed to self-employed. And I'm going to talk mostly about self-employed. All of the self-employed or proprietorship, which is the same thing. All of those expenses are the same for a corporation with a few minor differences. Now, a partnership, you can be self-employed in a partnership or incorporated in a partnership. So basically you are splitting the profits and expenses, and it does not have to be an even 50-50 split. It can be a 80-20 split if that's what you have written up in your partnership agreement. So determining which is the best one for you, it really depends on how much money you are making at the time. So definitely starting out, self-employed is the best way to go. If you are making, I would say getting up to $50,000 a year, you might want to consider incorporation. Now there's a few things to consider when you're incorporating. It does cost more for tax returns. So you have to have a higher profit to begin with to offset those additional expenses. So that is definitely something you have to look into. And at a certain point, you might want to actually talk to a tax professional about that. Because I'm not 100% sure whether it should be good for you or not to incorporate, but tax professional would help you, and Jeanette does know the name of a good tax professional also. So another thing I'm going to just touch on quickly is if you are running a business, you really should have a bank account for that business and not use your personal bank account. The same with a credit card. And that is because if you ever get audited by the government, then you're going to they're going to ask for you to produce bank statements. If you give them a personal bank statement, that is just opening up the whole ball of worms for them to delve into your personal expenses that you might not want them to go into. But if you have a business bank account, number one, it shows that it is a business. And number two, that's all they can ask for is a business bank account, business bank statements or credit card statements. So I highly recommend that you do get a business account or business account and a credit card account. So what receipts to save? This is the biggest question I get asked all the time. So I'm just going to go through a list of expenses that are claimable, and I will delve into some more than others because some are pretty well self-explanatory. So advertising and promotion. Facebook advertising, if you're paying for Facebook advertising, any posters, gift baskets, if you're doing any giveaways or anything like that, everything that goes into those are 100% claimable. Promotional giveaways, so you have a team and you're running a competition or giving some incentive to some of the members on your team, those are all 100% write-offs for your business. If you're renting a booth at a trade show, that's 100% write-off. Plus at the trade show, you're buying a case of water, I would write that off. It's part of the trade show expenses. Same with if you're giving out candies or something like that, that's also 100% write-offable. Business cards, any handouts that you give out also would fall under the advertising and promotion category. Supplies. Now this is an interesting one. You need supplies to run your business. Your supplies are the oils that you're buying to promote your business. Now, can you write off 100% of the oils you buy through Young Living? No. You cannot. You need to have a personal element in there, because some of them definitely you have bought for personal use. The majority of them, though, I would say you could write off, because if you don't have a wide assortment of oils for people to smell and test and whatever, then you can't really promote your business as well. So that is, I would say, now it changes for everybody, but I'd say probably about 80% you can write off. So professional fees. You can write off any professional fees. So lawyer, if you had to talk to a lawyer about your business, we hope not, but if you did, if you were incorporating and you needed to see a lawyer about that, you can write that off. A bookkeeper is a write-offable expense. It is a professional fee. So anything like that, bookkeeper, accountant, lawyer, business coach is also considered a professional fee. So you can write off those expenses. Telephone and internet, that's pretty self-explanatory. What I say for telephone most often, most people have cell phones, and that's what phone number is used for their business. So if they have a cell phone and a landline, I would say write off the cell phone as 100% business expense, and the landline is a personal expense. If not, then there should be a percentage of personal use in the telephone. Same with the internet. There should be a percentage of personal use in there. Any delivery and freight expenses, that's, to me, that's a given if you're sending stuff to other people. Bank charges. So bank charges, when you open your company bank account, that is a write-offable expense. Now, if you are working with a personal account, that is not write-offable. It needs to be a business bank account. Interest also. So if you're paying interest on a business credit card, that can be written off. If it is a personal credit card, not as easy to write off. It can be done. It's kind of the gray area with CRA. So again, it's a good reason why you should have a personal bank account and a business bank account and a business credit card. So office supplies, that would include pens, papers, stuff like that, printer, ink, any office supplies, office programs. So I don't know, do you have to pay for Zoom, Jeanette? If you do, that would be considered a office supply because it's part of running your office. Any reference books that you purchase, so reference books on the different types of oils to use, that is a write-offable expense. And of course, envelopes, postage, anything that you would use in your office is write-offable. So meals and entertainment, what to write off, what can you get away with? This is always one of those tough ones with CRA, and this is one of the ones that are audited the most. So a lot of times when CRA audits you, they only audit a certain area of what you've written off. And I have seen meals and entertainment audited. So one way to make them audit proof is to write on the receipt who you were entertaining. So if you have done a meal or given away tickets or something like that, and it has a business purpose, it is write-offable. So you have to list who you entertained, why you were entertaining them, and what you talked about. So I was really looking for a couple receipts, and I'm in Victoria right now, so I didn't have my stack at home that I usually do. But this is an example of, we're just going to pretend that these are the same, came from the same people also. So this is a restaurant in New York City, And this is what most of our receipts look like here for meals. So you have, on the left-hand side, you have a meal receipt with the sales tax listed in it. Then you get, because you've paid by your credit card, you get a credit card receipt and you add the tip on there. The tip is fully expensible. So I know that some people don't realize that, but you definitely can write off your tips on a meal. The thing with meals, though, is the government said that you can only claim 50% of your meals. So you have to keep track of them 100%. Because on your income tax return, it asks you for the claimable area. But when you're getting into an incorporated business, you need to keep track of it, especially, or even a proprietorship. And I'll talk about GST returns closer to the end, but you can write off the 5192. Now, let's just say that this was, I don't know, these receipts we're going to say they are from the same restaurant. If you just have the MasterCard or credit card receipt, the government has no idea what you're buying. So if you're ever audited, they might say, sorry, we don't know if you actually paid for a meal there. Gas receipts are the same way. We don't know if you just paid for gas there. Maybe you bought a whole bunch of other stuff at the gas station. So you really need to have both of those slips with your receipts. And please write on the receipts who they are to at the time, because that really makes it audit proof. So other meals that you can write off. I just talked about meals that, say, you've taken someone out with your business in mind. So other meals you can write off is travel. Now the government says you need to be out of your home area for 12 hours or longer if you are going to write off a receipt where you are not entertaining someone. So the travel meals are also only claimable by 50%. You do need to keep the total number of receipts, the total amount of receipts, 14 hours I have on there instead of 12 hours. I think it's 12 actually. But on the travel expenses, if you're taking your family somewhere also, wherever you've gone traveling, you can only claim your portion of those expenses, not your family's. Another way to claim meals and entertainment are events. Now, I'm putting events down here because in the tax laws it says employee events. So I am treating your downline as employees almost. That's what I'm relating to in this case. So if you offer an event to everybody in your downline, you can claim that 100% as opposed to the 50%, but you're limited to 6 a year. So the key in determining whether it is a 100% write-off is it available to everyone in your company or in your downline? If it is, even if not everybody's going to show up, then you can write it off. So that is like a Christmas party that you might have for your downline. That is 100% write-off, so you don't have to take the 50% portion out of it. Just as a note, in some of the other meals that you're claiming, if you take 4 people out and it's your business, you have 3 other people you're taking out, sorry, you can only claim 50%. So you can't claim 75% as a business write-off, you can only claim 50%. So auto expenses. Now, auto expenses are based on the percentage of usage. So percentage of usage for business usage compared to personal usage. When you are doing an income tax return, you have to put both those amounts on there, and that creates a percentage on what you're going to deduct for fuel, repairs and maintenance. So repairs and maintenance would cover any repairs that you have to do on the vehicle, car washes. Even if you are not getting a receipt for the car wash, you can record it as a cash payment for the car wash. As long as it's recorded somewhere, then it can be claimed. So it's one of the few expenses you do not need a receipt to back it up for. Insurance can be claimed. Interest on your car loan or a lease payment. Your registration, your license renewal, and parking also. So again, I have to stress, if you're using your vehicle for 20% business usage as opposed to personal usage, then you'll be able to claim 20% of all these, but you have to list it by 100%. The percentage is taken off at the end. So you need to keep track of everything. Mileage tracking. To keep track of these expenses, you need to keep track of your mileage, and it does ask for your mileage on your income tax return. So one of the best apps for a phone I have found is TripLog 2.0, which is available for iPhones or Android phones. Now, this is a really handy app. I discovered it a year ago. It works automatically. Whenever you get in your car, it starts tracking your mileage once you go over 5 miles an hour or 5 kilometers an hour or something like that. So I think my next shot is just a screenshot of what it looks like on your phone. So this is an Android phone. I'm not sure what it looks like on the iPhone, but I'm sure it's probably similar. So I get in my car, and you can actually, if it's an address you're going to quite often, you can actually name the address. So I've named my address home office because I work out of my home. Wherever I go, it just starts keeping track of the mileage. Now, at the end of the day or before the end of the month, I might think, not all of that was business mileage. So I can actually go in and I can change these buttons here and change them from business to personal or personal to business. Now, there's a whole bunch of other things you can set in here. If you have more than one vehicle, you can put more than one vehicle in here. If you are... you can keep track of a whole bunch of different stuff in here. So it's really handy. I find that trying to write down my mileage in a logbook is a pain in the butt. So that's why it was so nice to find this one. This one is worth about $24 a year. So it's not a free app. There is a free application in this, but it doesn't send you records of what you've driven. So this one you can actually email yourself every month or go back into the app and send it at the end of the year, a record of what you've driven. So it does track your business and personal mileage, which is what you need to do. So home office expenses. Again, it's based on percentage of usage of your house. So if you have one room in your house that you use for an office, and you have 10 rooms in your house, that is 20%. I think that's the right percentage, or 10%. 10%. Sorry, it's getting late in the day. I had a glass of wine already, so it's bad. So that is 10% of your house is used for a business. So of that 10%, for work in home space, you can claim your utilities. So if you heat your house with firewood, you can claim your firewood or propane or natural gas, electricity, water. So you need to keep track of 100% of these things. The percentage comes off at the end. Repairs and maintenance. So repairs and maintenance might be fixing a toilet seat or having someone come in and clean your house. That's considered repairs and maintenance. A determining factor in repairs and maintenance is if it is increasing the value of your house, you do not want to claim it. It is not repairs and maintenance then because it's increasing the value of your house. If it is not, then it's usually repairs and maintenance. So you break a window, I would say that's repairs and maintenance. If you are replacing your windows and making them more efficient, in the long run, it increases the value of your home. That would not be considered repairs and maintenance. So one of the things that you want to look at is it increasing the value of your house? If it's not, then it's repairs and maintenance. So, you know, flowers you plant in your front yard, that's repairs and maintenance because it's not really increasing the value of your house. Does it affect the value of your house when you're selling it? If you are claiming only the expenses on your house, no, it does not affect anything when you sell your house because you're only claiming expenses. Now, if you've claimed upgrading your windows, yes, that's increasing your house. So then it's all of a sudden changing your house from personal use to commercial use, and it's opening a whole other ball of worms. So don't do that. Just make it easy. Just claim the expenses. That's the easiest way to say it. It will not affect anything when you sell your house. So once you have figured out all of your expenses and your income coming in, are you making a profit? And that's what it's all about, running business. Are you making a profit? So there's a couple things. You cannot claim house expenses to create a business loss. You can carry forward expenses if you have a business loss, but you cannot go below zero when you're claiming house expenses. So I don't know if that's making sense to you guys or not, but if you need more clarification on that, I will at the end if you're asking questions. So let's talk about GST and small business. So if you have additional self-employed income, chances are that you should be, and you're making more than $30,000, you need to be claiming GST. And this additional self-employed income, it doesn't matter if it's only $1,000. If it has put your income over $30,000, the government says you have to claim GST. Now, is this a bad thing in your business? No, not at all. The income you get from Young Living, you do not pay the GST on it, so you do not have to collect the GST on it. You do have to collect GST on everything else. So if you're making gift baskets, or if you're making, maybe you make home products with your oils, maybe you're giving raindrop therapy massages. If you are making additional income than the income that Young Living is giving you, and it's over, your total income is over $30,000, your total self-employed income is over $30,000, you need to start collecting GST. Now, it's not a bad thing because all of those expenses that you paid, you get to write off that GST that you've paid against the GST that you're collecting from the income. So in most cases, you would get a GST return back from the government. So you think, okay, all I do is sell Young Living oils. Um, I don't do anything else. Why don't I get a GST number so I can write off all the GST I paid? You have to look in to the different options on how much is it going to cost to record that GST to get it back. So that's really what you have to think about. Is it worth making that claim if I'm not getting enough money back? And Jennifer, you're shaking your head. I can see that. You're correct. It's not usually. Unfortunately, I'm just going to tell you a story about one of the girls that I do her income tax for. And I started doing her income tax for her in probably 2012, something like that. She was with the same kind of company, and she was making probably about $100,000 a year. She was thinking, wow, I'm really racking it in. Well, when I actually did her books for her, her expenses were way higher than that. So yeah, she was making a lot of money, but because she was traveling around so much, she had a lot of travel expenses. She had a lot of expenses from the trade shows she went into. She wasn't making any money. So it's a matter of also keeping track of your expenses so you know whether you're making money or not. Now, probably about 3 years ago, she also did raindrop massages. About 3 years ago, the government came back to her and said, you're making over $30,000. You need to be collecting GST, and this is how much we think you owe. So all they did was take her income that was not the company income that she was getting from her business. They took all of her massage income, her income from selling books, because she did that also, and assessed how much she owed. So she came to me and she goes, what is this all about? And I said, well, let's figure it out. So I figured it out, and it ended up she got, I don't know, the 3 years she was behind, I think I got her back about $750 roughly, and every year she gets about $300 back. Now it does take more for me to figure out what her expenses are, but she does get money back. So it doesn't matter if like $30,000 is that threshold. It could be $35,000 of Young Living income and $2,000 worth of massage income. That is still considered income that you have to declare. So she has to charge GST to her clients on her additional income. But she does get to write off everything else. So it depends on the size of your business and what you're doing. Now, if all you have is Young Living income, you don't have any additional income, it's pretty well what you can write off, and does it offset the amount of what it costs to figure that out. So programs to make your life easier to keep track of expenses. Now, being a bookkeeper, I use more in-depth programs. So I use a program called Xero, which is a full accounting program. QuickBooks Online also is a full accounting program. They are more expensive than other programs out there that you can get to keep track of your business. To me, as a bookkeeper, I just find them easier. Wave is an online accounting program that is free of charge. A lot harder to use, but it's free of charge. Quicken is a program you can buy. It's a personal finance program. It will keep charge of the expenses for you. So will an Excel worksheet. It's just whatever you find easiest, what you think the cost is worth to you, and what you can figure out how to use, basically. So I, as a bookkeeping company, offer services. I've put together some packages for people. So if you came to me with a shoebox full of receipts at year end, I would probably charge you $275 to figure out all of your business expenses as opposed to your personal expenses. That does not include the tax preparation for it. That just includes sorting everything out. But if you took it to a tax professional, they would probably charge you more to figure out all the receipts, to add up all the receipts and stuff. I also offer a couple different options. I do books for people quarterly. I would charge them $100 quarterly, and they would be on top of what they owe. So, or on top of what they're making throughout the year. So that's a good option. And then I offer a monthly option for people also, so they can really stay on top of whether they're making money and whether they're not. When you are figuring out your receipts monthly, you don't forget stuff, because it's really easy to forget stuff throughout the year. So even if you're sticking them in a stack, if you haven't written on the receipt who the receipt is for, if you've taken somebody out, it's hard to do. So it's just easier to stay on top of it. So that's just about everything. This is my contact information. So I can definitely talk to anybody if they have questions. If they're interested in using my services, then definitely get a hold of me. And now we can just open it wide for questions.
Yeah, you bet. I've got the one question. Thanks, Marna. That was fantastic. The one question that we did have early on was, when should someone get a business bank account? When you were talking about in the beginning a business bank account and a business credit card, should we get that right off the hop? Does that cost anything? When should that happen?
You really should get it right off the start, because you're trying to prove to the government also that you are doing this for business purposes. So it really is a good idea to get it right off the start. Now, just because you are getting a, hold on, sorry. Just because you are getting a business bank account doesn't need to necessarily make it a business bank account. You can go in and get a personal bank account and use it 100% for business reasons. So it doesn't have to be per se a business bank account. It just needs to be a separate bank account or a separate credit card.
Right, and that's what I did for a long time. So what I did is I just had, a second bank account. And that's just where anything Young Living went in and out of, just to keep it somewhat separate. And then I know I've been asked a few times, when did I go incorporated? I didn't go incorporated till I was platinum. So kind of after we started making the $10,000 a month mark, then we decided to go incorporated. And we just kind of did the partnership, and then we went incorporated thereafter. And but it is nice to have everything separate in its own bank account and its own credit card, where it's in that, not mucking up your personal stuff, So would it be bad? So like I said to you, Marna, we do have a few people that are making $100 a month and some people making $10,000 a month. So would it be bad to start keeping track now, even though they've been doing this for about a year? They only make $100 to $200 a month. So is it okay just to start now?
Definitely. You have to claim that $100 a month you're making. So you might as well keep track of your expenses and write off that $100. Right. So the expenses go against the business income that you're making. So any of your expenses are going against the $100 a month you're bringing in. So it really takes your income down to zero. So that's all what it's all about, is paying the least amount of taxes.
Yeah, totally. And then we want clarification too, when you were talking about the $30,000 a year, we're talking about your self-employed income, right? That doesn't mean your husband's job money.
Correct.
And that's just
Correct.
whatever you're getting from Young Living, if it's under or over 30,000.
Correct. And it is gross income also. It's not income after expenses.
Yeah. So a great question here. And Marna is oily. Marna does use the oil, so she understands the way our business works very well. Rebecca asks, what about people who sign up 3 people and they get, you know, $200 back, but then they never sign anybody up again? I'm not sure, Rebecca, would you want to unmute yourself and ask that? Because, I mean, if they're not in it for the business, then they don't care about tax write-offs and they would just carry on. And as far as it would be for you, then you would still claim everything as usual.
I think just my question is, like, if they're sort of like, well, maybe I want to get like the little bit of residual income every month from those 3 people, like if their friends sign up and get a little bit of residual, but that's all they want to do, like they don't want to pursue anything more than that, what should they do and how can we help them in that? And sort of then they're not like, oh crap, I'm now going to the business side of things, and not freak out about it.
So they really have to determine whether they're doing it for a hobby so they can use the oils themselves, or if it is a business that they're doing. So it comes down to proving to the government, yes, I'm doing this for business purposes. So you know, that's where you have to justify it.
And at what point should we have that conversation with somebody? Just because, like, I'm just thinking of a few people that might sign up and are intrigued by getting the 3 signups, and then maybe, like, say 6 months down the road, they think, oh, like, I kind of want to continue getting my 100 PV every month so I can get a little bit of money. Like, at what point should it be, like, right off the bat, or wait till they've made that decision a little bit later on?
I think it
am I clear? Is that
yeah,
make sense?
I think it boils down to when their intention changes. It's about their intention. Are they intending just to like have it be a hobby? Then there's no conversation required. They're just doing what they want to do. And then if their intention changes to it actually being a business purpose, then I think that's when you would sit down and have that conversation with them about the tax benefits and possibly talking to a bookkeeper like Marna.
So if they're just doing it simply as a hobby, they're not interested in the business, like fully doing the business side of things, then do they need to keep track of it? Do they need to claim that money that they're making, even if it's, you know, a little bit every month?
Well, if they're getting a T4A from Young Living, they're going to want to write off any expenses to negate that T4A down to 0.
Okay.
Okay, Marna, can you stop sharing your screen? And I just want to help you see some of the group chat too, because there's a big, perfect. We've got a big one. If you just touch on chat on the bottom, it'll bring up, we've got a few questions here. So what about if you are employed as well as self-employed? And do you see those questions?
Yes. Okay, so you can be both. You can be employed and you can be self-employed. It's just a different, an additional form on your tax return. So that is no problem whatsoever. In fact, a lot of people are like that until they can actually, you know, make enough money to quit their employment. So yes, that's no problem.
Would our monthly Essential Rewards order go on our business credit card or our personal credit card and expense business portion?
Either or.
Yeah, I put it on the business credit card because it's business, it's Young Living, it's what we do, and then I just hash out like what percentage of it would be for personal use after.
Exactly. And that's probably the easiest way, because most of the stuff you buy is a business expense. So most of the oils that you're purchasing are a business expense.
Totally. Can you claim rent if you live in a rental?
Yes, you can.
Yeah. And my husband and I have a business, a numbered company. Can I just put my Young Living in the same company? Can we just put the YL money into the business account and immediately transfer it out?
Yes and no. So yes, you can run any number of businesses underneath a numbered company. When it comes to actually doing the returns, you have to say what type of business is your primary type of business. And that's how you that number has to be claimed with the government. So yes, you could. Whether it is, you have to remember, if you're doing that, then GST needs to be taken into consideration, most likely also. Did that answer the question? I don't know if it really
Maybe
did
it
or not.
requires further investigation.
Exactly. Exactly.
Fantastic. Okay, does anybody else have any other questions while we have Marna on right now?
And Alice, writing the stuff on the invoice is the best way to keep track of it, because you know when it's coming in, what it is.
Exactly.
So that's definitely the best time to do it, when it's fresh in your mind.
Yeah, most of my problem has been, you know, your people coming back to me, Marna, and saying, what happened in June on the 16th? And I'm going, I have no idea. Earlier the better. Just writing it down as they come in is best. And even like where it goes into my purse while I'm at Starbucks, I'm having a coffee with so-and-so into my purse, then it's done, right? So
exactly.
curious.
So question on GST.
Yeah.
Does GST need to be over 30,000 just young living? Where you really have to pay attention to the 30,000 threshold, say you were getting $28,000 from Young Living, but you were doing something else that took your income over 30,000. So say you were giving, you know, $3,000 worth of massages a year. And so now your income is 31,000. Yeah, you have to start claiming GST once you reach that 30,000 threshold.
Cool. Yeah, Alice?
And it is not on personal income, it's only on business income. So your child tax credits don't affect your business income whatsoever. That's personal completely. Neither does another job. So it is just the income that you are making from your business.
So I have a question with the GST, because it's throwing me for a loop. I've been thinking about this for a while. I don't do make and takes. I don't do massages. Well, I do some make and takes and stuff, but not a whole lot that I charge. It's more educational purposes. Yeah. Would I still, even though most like my income is basically Young Living commissions, would I do GST?
Is it over $30,000?
Yeah.
You would only have to charge, if it's over $30,000 and you're charging for the make and takes.
Okay.
Then you would have to claim it.
If I wasn't charging for the make and takes?
Then you don't have to claim it.
Okay. Thank you.
Yeah, and to speak on that, Alice, because of how few of them I do, I just waived it too. I just said, even if I take the $5 in cash here and there, it's just not worth the amount of like that I do 2 a year or whatever. I would rather just say, it's free, whatever, and call it a day. Yeah.
Yeah, GST is one of those tough things.
Yeah.
The government's very firm on that $30,000. And when I was doing this other person's, it was a shock to get the paper from the government, because I had no idea that, you know, her $5,000 additional income would affect it. But yeah, it does.
Okay. All right, I think we're going to end there. Marna, thank you so much for your time. We really appreciate it. I'm going to put Marna's information on our group. So if you guys do want to reach out to her for whatever reason and have some questions answered or see if she can help you, then definitely feel free to do that. Also, don't forget to share this for your teams, you guys. I'll upload it and it can be shareable for you guys so that everyone else can have access to this information. And again, thank you so much, Marna, for taking time while you're in Victoria on holiday to do this for us. And I hope you guys have a good night. Thanks for joining.
Thanks, everyone. Bye now.